Welcome back, dear students. With respect to our second chapter, Banking Institutions, today we are learning the 11th session, which will speak about banking sector reforms. Before learning about the modern reforms in banking sector, we should have an idea of the historical background of banking reforms. At the time of independence, the Indian banking system was not very sound. There were many private banks in India under faulty and exploitative managements. Hence, in 1949, two major steps were taken from the point of view of structural reforms in the banking sector. Firstly, the Banking Regulation Act of 1949 was passed. It gave wide ranging regulatory powers to the Reserve Bank of India over the commercial banks in India. Secondly, the Reserve Bank of India was nationalized in 1949. These two major developments were of critical importance as far as the evolution of commercial banking in India is concerned. The Indian banking reform or the Indian banking system in the pre reform period largely operated according to the needs of mixed economy in which the public sector enjoyed a commanding role. The bank nationalization in India was geared towards meeting the unique socio-economic needs of society afflicted by widespread poverty and gross underdevelopment. In such a framework, planned economic development involved enormous development expenditure. Such expenditure was met through the government ownership of banks. The instruments like statutory liquidity ratio, the cash reserve ratio, priority sector lending norms, administered interest rates, underpinned by social concerns, etc. In recent years, the Indian economic environment has seen a lot of changes because of reforms and measures taken by the banks. The largest change is seen in the financial sector, where the banking sector is the largest player to notice this change. So, the banking sector is strong enough to withstand any sort of pressure and competition. Thus, these trends in banking have been very visible in the last few years. India now has a fairly stable banking sector with different classes of banks contributing to it. Thus, these include foreign banks, public banks, private sector banks, and others. Reserve Bank of India is head of all these banks. Now let us learn about the Indian banking sector's existence. Evolution of Indian banking industry. First generation banking. During the pre independence period till 1947, the Swadeshi movement saw the birth of many small and local banks. Most of them failed mainly due to the internal frauds, interconnected lending, and the combining of trading and banking books. Second generation banking, which took place between 1947 to 1967, Indian banks facilitated concentration of resources, that is mobilized through retail deposits, in a few business families or groups, and thus neglected credit flow to agriculture. Third generation banking, which took place between 1967 till 1991. The government was successful in breaking the nexus between industry and banks through the nationalization of 20 major private banks in two phases. One in 1969 and the other one in 1980, and introduction of priority sector lending in the year 1972. These initiatives resulted in the shift from class banking to mass banking. Further, it had a positive impact on the expansion of branch networks across India, including rural areas, massive mobilization of public deposits, and incremental credit flow to agriculture and allied sectors. Fourth generation banking, which took place between 1991 to 2014. This period saw landmark reforms such as issue of fresh licenses to private and foreign banks to infuse competition, enhance productivity as well as efficiency. This was done by leveraging technology, introduction of prudential norms, providing operational flexibility coupled with functional autonomy, focus on implementation of best corporate governance practices, and strengthening of capital base as per the Basel norms. Current model, that is since 2014 onwards, the banking sector has witnessed the adoption of the JAM, that is J stands for Jan, D stands for J stands for Jandan, A stands for Aadhaar, and M stands for mobile. That is Jandan, Aadhaar, and Mobile Trinity, and issuance of licenses to payments banks and small finance banks to achieve last minute connectivity in the financial inclusion drive. Then the fifth generation banking, that is big banks. The Narasimhan Committee report of 1991 emphasized that India should have 3 or 4 large commercial banks with domestic and international presence along with foreign banks. The second tier may comprise several mid-sized lenders including niche banks with economy-wide presence. In accordance with these recommendations, the government has already merged a few PSBs, that is public sector banks, initiated steps towards setting up of DFI, bad bank, etc. Then we learn about the need for differential banks. Though the universal banking model has been widely preferred, there is a need for niche banking to cater to the specific and varied requirements of different customers and borrowers. Essentially, these specialized banks would ease the access to finance in areas such as RAM, that is retail, agriculture, and MSMEs. Further, the proposed DFI or niche banks may be established as specialized banks to have access to low cost public deposits and for better asset liability management. Blockchain banking. Risk management can be more specific, and the neobanks can leverage the technology to further, that is the digitalization, financial inclusion, and finance higher growth of aspirational new India. In this context, technologies like blockchain can be implemented in Indian banking. Blockchain technology will allow prudential supervision and control over the banks may be easier. Next is mitigating moral hazard. Till date, failure of public sector banks has been a rare phenomenon, and the hidden sovereign guarantee is the main reason for superior public confidence in the banks. However, with the privatization drive of PSBs, this may not be always true. Therefore, fifth generation banking reforms should focus on the need for higher individual deposit insurance and effective orderly resolution regimes of to mitigate moral hazards and systematic risks with least cost to the public exchequer. ESG framework. Differentiated banks also may be encouraged to get listed on a recognized stock exchange and adhere to ESG, that is environment, social responsibility and governance framework to create value for the stakeholders in the long run. Empowering banks. The government should tighten the loose ends by allowing them to build diversified loan portfolios, establishing sector wise regulators, bestowing more powers to deal effectively with willful defaulters. There is also a need to pave the way for the corporate bond market, that is shift from bank led economy to create a responsive banking system in a dynamic real economy. Next, trends in banking. So, in most of the reforms, we are going to learn about the most trendy banking activities happening. Banking systems and financial institutions are integral part of an economy. Seamless functioning of these sectors is important for an economy to grow. Due to the advent of digital technology, banking, and financial services have undergone a massive shift in their mode of operations. New trends are gaining momentum at a fast pace as the customers find it convenient and also flexible at the same time. The emergence of financial technology has resulted in the introduction of several technological advancements in the industry. In recent years, there have been many changes in the banking industry. These trends in banking have made the whole process of banking very easy. These trends include the following. First one, RTGS, which stands for Real Time Gross Settlement. RTGS was introduced in India in March 2004. It is a system through which a bank receives instruction in the form of electronic for transferring the funds from one bank to other bank accounts. As the name suggests, the transfer of funds between the accounts takes place in real time, that is, the RTGS system. The RTGS system is kept running and maintained by the RBI. Next is e-check. This technology has been developed in the US, which will replace the conventional paper check in India. Thus, to include this method of e-check and make it mandatory, a Negotiable Instruments Act has been included in the amendment. ECS, Electronic Clearing Service, is an electronic system that is used to make the payments and receipts that are in bulk. The payments need to be similar in nature, which can be smaller in amount and repetitive in nature. Thus, this facility is specifically beneficial to government agencies and companies that make or receive large bulk payments. EFT, that is Electoral Funds Transfer. This is a system to transfer the money from one's bank account to other accounts. So, in this system, the concerning party that wants to make the payment instructs the banks and make a cash payment or authorizes the bank to transfer the funds directly. So, the sender should provide the bank with the complete details like the name of the receiver, account type, account number of the respective bank, city name, branch name, and other details to the bank. Next one is ATM, which stands for Automatic Teller Machine. This is the most popular method in India to withdraw the money. The customers can enable this service to withdraw money 24 by 7. It allows the customers to perform all day-to-day bank activities without interacting with any humans Furthermore, these facilities are also used for the payment of funds, utility bills, etc. Thank you, dear students. So, we will meet up again in the next session with the most important banking reforms. Till then, take care. Bye.